Question 1. An individual has a life insurance policy and wants to ensure that if they pass away, the death benefit is paid in regular installments to their beneficiary rather than a single lump sum. Which policy provision or option allows for this? A. Automatic premium loan. B. Non-forfeiture option. C. Dividend option. D. Settlement option. Answer: D. Settlement option. A settlement option determines how the death benefit from a life insurance policy will be paid out to the beneficiary, allowing for various methods beyond a single lump sum, such as fixed-period installments or a lifetime income. This provision provides flexibility and financial planning for the beneficiary, ensuring they receive the funds in a structured way that might better meet their needs, like covering ongoing expenses. For instance, an insured might choose an interest-only option for their spouse, with the principal paid to children later, or a fixed-amount option to guarantee a specific income for a set period. Always review settlement options to align with your beneficiary's financial needs and avoid large, immediate payouts that might be mismanaged. Question 2. What is the primary purpose of the Medical Information Bureau, MIB? A. To assist insurers in marketing new policies to potential clients. B. To provide a centralized database of medical claim denials. C. To help underwriters evaluate risk for life and health insurance applicants. D. To facilitate communication between hospitals and insurance companies. Answer: C. To help underwriters evaluate risk for life and health insurance applicants. The Medical Information Bureau, MIB, is a non-profit organization that collects and shares coded health information among member insurance companies regarding an applicant's medical history and hazardous hobbies. Its primary purpose is to help underwriters detect fraud, misrepresentation, and omissions on insurance applications, ensuring a more accurate assessment of risk. For example, if an applicant fails to disclose a serious medical condition on their application, the MIB might flag this inconsistency if it was reported by a previous insurer. Remember, the MIB helps insurers make informed underwriting decisions, leading to fair premium rates for all policyholders. Question 3. Which of the following is characteristic of a universal life insurance policy? A. It has a fixed premium and fixed death benefit. B. It offers flexible premiums and an adjustable death benefit. C. It provides coverage only for a specific period of time. D. Its cash value grows at a fixed rate, guaranteed by the insurer. Answer: B. It offers flexible premiums and an adjustable death benefit. Universal life insurance is a flexible type of permanent life insurance that allows policyholders to adjust their premium payments and death benefit amount within certain limits. This flexibility means policyholders can increase or decrease premiums, or even skip payments if the cash value is sufficient, and also change the death benefit as their needs evolve. For example, if a policyholder experiences financial hardship, they might reduce their premium for a period without losing coverage. Universal life is recognized for its adaptability, which contrasts with the more rigid structure of traditional whole life insurance. Question 4. All of the following are components of the cost of insurance in a health policy, except A. Morbidity. B. Interest. C. Expenses. D. Dividends. Answer: D. Dividends. The cost of insurance in a health policy is primarily determined by morbidity, the likelihood of sickness or injury, interest, earned on invested premiums, and expenses, the insurer's operating costs. Dividends, on the other hand, represent a portion of the insurer's surplus returned to policyholders in participating policies and are not a component of the initial cost calculation. Think of dividends as a refund, not a factor in determining the premium charged up front. Keep in mind that dividends are never guaranteed and depend on the insurer's financial performance. Question 5. In a group health insurance plan, what is the master policy issued to? A. Each individual employee covered under the plan. B. The employer or the sponsoring organization. C. The insurance producer who sold the policy. D. The State Department of Insurance. Answer: B. The employer or the sponsoring organization. In a group health insurance plan, the master policy is issued to the group sponsor, typically the employer or an association, which then provides certificates of coverage to individual members. This structure simplifies administration, as the employer acts as a liaison between the employees and the insurer, handling premium payments and enrollment. For example, if an employee has a question about their benefits, they would typically go through their employer's HR department, who holds the master contract. Remember, the master policy outlines the terms and conditions of coverage for the entire group, while individual certificates merely confirm participation. Question 6. A life insurance policy's cash value, if surrendered, would be subject to taxation on what amount? A. The total cash value accumulated. B. The total premiums paid into the policy. C. The amount exceeding the premiums paid into the policy. D. The death benefit minus the cash value. Answer: C. The amount exceeding the premiums paid into the policy. When a life insurance policy with a cash value is surrendered, any amount received by the policyholder that exceeds the total premiums paid into the policy is considered taxable income. This is because the cash value growth, up to the amount of premiums paid, is essentially a return of capital and therefore not taxed. For instance, if you paid $10,000 in premiums and received $12,000 upon surrender, only the $2,000 gain would be taxable. Remember, the growth within the cash value is tax-deferred until it is accessed and exceeds the cost basis. Question 7. Which of the following terms describes the period during which an annuitant is making payments into an annuity? A. Annuitization period. B. Liquidation period. C. Accumulation period. D. Distribution period. Answer: C. Accumulation period. The accumulation period is the phase in an annuity contract during which the annuitant, the contract owner, makes payments into the annuity, and the money grows on a tax-deferred basis. This period can last for many years, as the funds compound through interest or investment gains. For example, if someone buys a deferred annuity at age 40 and plans to start receiving income at age 65, the 25 years in between would be the accumulation period. Once payments begin, the contract enters the annuitization or liquidation period. Question 8. An applicant for health insurance has a pre-existing condition. Under the Affordable Care Act, ACA, what is the insurer's ability to deny coverage or charge more due to this condition? A. Insurers can deny coverage but cannot charge more. B. Insurers can charge more but cannot deny coverage. C. Insurers cannot deny coverage or charge more. D. Insurers can deny coverage and charge more if the condition is severe. Answer: C. Insurers cannot deny coverage or charge more. Under the Affordable Care Act, ACA, insurers are prohibited from denying coverage or charging higher premiums to individuals based on their health status, including pre-existing conditions. This means that an applicant with a pre-existing condition, such as diabetes or heart disease, must be offered coverage at the same rates as healthier individuals. The ACA's guaranteed issue and community rating provisions aim to ensure access to health insurance regardless of an individual's medical history. This provision was a significant change designed to protect vulnerable individuals from being priced out of or denied health coverage. Question 9. What is the primary purpose of the entire contract provision in a life insurance policy? A. To allow the insurer to amend the policy at any time. B. To ensure that the policy, application, and any riders constitute the complete agreement. C. To give the policy owner the right to surrender the policy for its cash value. D. To define the grace period for premium payments. Answer: B. To ensure that the policy, application, and any riders constitute the complete agreement. The entire contract provision states that the life insurance policy itself, along with the application and any attached riders or amendments, constitutes the complete and only agreement between the insurer and the policy owner. This provision is crucial because it prevents the insurer from introducing additional documents or rules outside of the policy to deny a claim. For example, an insurer cannot later claim that an unattached brochure or an oral statement made by an agent is part of the contract's terms. It protects the policyholder by clearly defining the full extent of the agreement and ensures that everything relevant is contained within the policy documents. Question 10. What is the function of a gatekeeper in a health maintenance organization, HMO, plan? A. To process all claims submitted by specialists. B. To market the HMO plan to new members. C. To control costs by requiring referrals to specialists. D. To manage the HMO's financial investments. Answer: C. To control costs by requiring referrals to specialists. In an HMO plan, the primary care physician, PCP, often referred to as the gatekeeper, is responsible for managing a patient's overall healthcare and must provide a referral for the patient to see a specialist. This mechanism helps control costs by ensuring that patients only see specialists when medically necessary, preventing unnecessary specialist visits. For example, if an HMO member needs to see a dermatologist, they must first visit their PCP to get a referral before the HMO will cover the specialist visit. Understanding the gatekeeper's role is key to navigating an HMO and accessing specialized care. Question 11. Which life insurance rider guarantees the policy owner the right to purchase additional insurance at specified future dates or events without evidence of insurability? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Payer benefit rider. Answer: C. Guaranteed insurability rider. The Guaranteed Insurability Rider, GIR, is a valuable life insurance option that allows the policy owner to purchase additional amounts of life insurance at predetermined future dates or upon certain life events, like marriage or the birth of a child, without having to prove their insurability. This means that even if the insured develops a serious health condition, they can still acquire more coverage. For instance, a young professional might add this rider to ensure they can increase their coverage as their family grows, regardless of any future health issues. The GIR is designed to protect your ability to expand coverage as your life circumstances change. Question 12. A policy owner cancels their individual health insurance policy and receives a refund of the unearned premium. This type of refund is typically calculated on what basis? A. Pro rata basis. B. Short rate basis. C. Flat rate basis. D. Annually renewable basis. Answer: B. Short rate basis. When a policy owner cancels an individual health insurance policy before its expiration date, the refund of the unearned premium is typically calculated on a short rate basis. This means the insurer retains a portion of the unearned premium as a penalty for early cancellation, resulting in a refund that is less than a proportionate amount. In contrast, a pro rata refund would return the full unearned premium without penalty, which is usually reserved for cancellations initiated by the insurer. Remember, the short rate method is designed to compensate the insurer for the administrative costs associated with policy issuance and early termination. Question 13. Which of the following statements regarding the taxation of disability income benefits is generally true? A. Benefits are always taxable if the employer pays any portion of the premiums. B. Benefits are fully taxable if the premiums were paid with after-tax dollars. C. Benefits are tax-free if the employer paid 100% of the premiums. D. Benefits are tax-free if the individual paid 100% of the premiums with after-tax dollars. Answer: D. Benefits are tax-free if the individual paid 100% of the premiums with after-tax dollars. If an individual pays 100% of the premiums for their disability income policy with after-tax dollars, the benefits received are generally tax-free. This is because the premiums were paid with income that had already been taxed, so the IRS does not tax the benefits again. Conversely, if an employer pays all or part of the premiums, the portion of the benefit attributable to the employer's contribution is usually taxable to the employee. For example, if your company pays for your disability insurance, any benefits you receive from it will likely be considered taxable income. Always consider the tax implications when deciding who pays for a disability income policy. Question 14. Which non-forfeiture option allows a policy owner to use the cash value of a lapsing policy to purchase a fully paid-up policy of a reduced face amount? A. Extended term. B. Cash surrender value. C. Reduced paid-up. D. Automatic premium loan. Answer: C. Reduced paid-up. The reduced paid-up non-forfeiture option allows a policy owner to use the existing cash value of a lapsing permanent life insurance policy to purchase a new, fully paid-up policy with a smaller face amount. No further premiums are required, and the coverage continues for the rest of the insured's life. For example, if you have a $100,000 policy and choose this option, you might end up with a $30,000 policy that is paid in full. This option is beneficial if you want to maintain some level of permanent coverage without continuing to pay premiums. Question 15. What is the maximum duration for which short-term disability insurance typically pays benefits? A. 1 year. B. 2 years. C. 3 years. D. 5 years. Answer: B. 2 years. Short-term disability insurance policies typically provide benefits for a maximum duration of up to 2 years, often with common benefit periods ranging from 3 months to 1 year. This coverage is designed to replace a portion of income for temporary disabilities that prevent an individual from working. For example, a short-term policy might cover a recovery period after surgery for a few months. If a disability extends beyond this period, a long-term disability policy would typically take over. Question 16. A policy owner decides to replace an existing life insurance policy with a new one. What is a key responsibility of the replacing insurer's agent in this scenario? A. To encourage the policy owner to surrender the existing policy immediately. B. To submit a replacement notice to the existing insurer. C. To advise the policy owner to retain the existing policy until the new one is issued. D. To waive the incontestability period on the new policy. Answer: B. To submit a replacement notice to the existing insurer. When a life insurance policy is replaced, the replacing insurer's agent has a key responsibility to submit a replacement notice to the existing insurer. This notification ensures that the original insurer is aware of the potential replacement and can contact their policyholder to discuss the implications, safeguarding against potential abuses like twisting. For example, the replacing agent must provide the applicant with a notice regarding replacement before submitting the application. Always prioritize transparency and proper procedure in replacement situations to protect the client's best interests. Question 17. Which statement accurately describes the tax treatment of group life insurance premiums paid by an employer? A. Premiums are generally tax-deductible for the employer. B. Premiums are generally taxable income to the employee. C. Premiums paid for coverage up to $50,000 are taxable to the employee. D. Premiums are never tax-deductible for the employer. Answer: A. Premiums are generally tax-deductible for the employer. Premiums paid by an employer for group life insurance are generally considered a tax-deductible business expense for the employer. This encourages employers to provide valuable benefits to their employees. However, the cost of coverage exceeding $50,000 per employee is considered taxable income to the employee. For instance, if an employer pays premiums for an employee's $75,000 group life policy, the cost of the $25,000 coverage above the limit would be imputed as income to that employee. Remember, the $50,000 threshold is a common exception to the otherwise tax-deductible nature of employer-paid premiums. Question 18. What is the primary role of a producer in the insurance industry? A. To underwrite policies and assess risk. B. To represent the insurer and sell insurance policies. C. To adjust claims and determine payouts. D. To set premium rates and design new products. Answer: B. To represent the insurer and sell insurance policies. A producer, also known as an agent or broker, acts as a representative of the insurer or client to sell and negotiate insurance policies. Their primary role is to connect consumers with appropriate insurance products, explain policy features, and guide applicants through the application process. For example, a producer might help a family choose the right life insurance policy based on their financial needs and budget. Remember, producers are the frontline professionals who help individuals and businesses acquire insurance coverage. Question 19. A Medicare enrollee wants to supplement their original Medicare coverage to help pay for deductibles, copayments, and coinsurance. Which type of policy would they purchase? A. Medicaid. B. Medicare Supplement, Medigap. C. Medicare Advantage, Part C. D. TRICARE. Answer: B. Medicare Supplement, Medigap. A Medicare Supplement policy, also known as Medigap, is designed to help pay for the gaps in original Medicare coverage, such as deductibles, copayments, and coinsurance. These standardized plans are offered by private insurance companies and work in conjunction with Medicare Parts A and B. For instance, if original Medicare pays 80% of a doctor's bill after the deductible, a Medigap policy could cover the remaining 20% coinsurance. Medicare supplement policies provide predictable out-of-pocket costs and allow beneficiaries to see any doctor who accepts Medicare. Question 20. Which of the following is a key characteristic of a hospital indemnity policy? A. It pays for actual medical expenses incurred during a hospital stay. B. It provides a fixed dollar benefit for each day the insured is hospitalized. C. It covers all costs associated with long-term care in a nursing home. D. It functions as primary health insurance, covering doctor's visits and prescriptions. Answer: B. It provides a fixed dollar benefit for each day the insured is hospitalized. A hospital indemnity policy is a supplemental health insurance plan that pays a predetermined, fixed dollar benefit for each day the insured is hospitalized, regardless of the actual medical expenses incurred. This lump sum payment can be used by the policyholder for any purpose, such as covering lost income or non-medical expenses related to the hospitalization. For example, a policy might pay $200 per day for every day spent in the hospital, which the insured could use to pay for childcare or mortgage payments. Remember, these policies are not designed to cover medical bills but rather to provide cash support during a hospital stay. Question 21. What is the purpose of the Coordination of Benefits (COB) provision in group health insurance? A. To ensure that an employee's medical expenses are fully covered by a single plan. B. To prevent an individual from receiving duplicate benefits from multiple group plans for the same claim. C. To determine which primary care physician an individual must use. D. To coordinate payments between the insured and the medical provider. Answer: B. To prevent an individual from receiving duplicate benefits from multiple group plans for the same claim. The Coordination of Benefits (COB) provision in group health insurance is designed to prevent overpayment when an individual is covered by more than one group health plan, ensuring that the total benefits paid do not exceed the actual medical expenses. This provision establishes which plan is primary and which is secondary, dictating the order in which benefits will be paid. For example, if a married couple each has group coverage through their employers, the COB rules determine how claims for their children will be processed, preventing them from receiving double payment for the same healthcare service. Understanding COB is crucial for managing claims when multiple coverages are in place. Question 22. Which of the following is a characteristic of a Preferred Provider Organization, PPO? A. Members must select a primary care physician, PCP, and obtain referrals to specialists. B. Members are restricted to receiving care only from providers within the PPO network. C. Members pay lower out-of-pocket costs when using in-network providers, but can choose out-of-network providers for a higher cost. D. It is a government-funded health insurance program for low-income individuals. Answer: C. Members pay lower out-of-pocket costs when using in-network providers, but can choose out-of-network providers for a higher cost. A preferred provider organization, PPO, allows members to choose any healthcare provider, but they receive a higher level of benefits and pay lower out-of-pocket costs when using providers within the PPO's network. Members have the flexibility to seek care outside the network, but they will incur higher deductibles, copayments, or coinsurance. For instance, a PPO member might pay a 20% coinsurance for an in-network doctor but 40% for an out-of-network one. This flexibility, while offering broader choices, comes with a cost differential. Question 23. What is the primary purpose of the free look period in a life insurance policy? A. To allow the insurer to review the application again for accuracy. B. To give the policy owner a specified period to review the policy and return it for a full refund if dissatisfied. C. To permit the policy owner to change beneficiaries without charge. D. To enable the insurer to contest claims within the first 2 years. Answer: B. To give the policy owner a specified period to review the policy and return it for a full refund if dissatisfied. The free look period, also known as the right to examine period, is a mandatory provision in life insurance policies that gives the policy owner a specific number of days, usually 10 to 30, after policy delivery to review the contract. If the policy owner is not satisfied for any reason, they can return the policy to the insurer for a full refund of all premiums paid. For example, if you receive your policy and realize it doesn't meet your needs, you can return it within this period without financial penalty. This provision is designed to protect consumers and ensure they are comfortable with their purchase. Question 24. Which of the following best describes the per capita designation for beneficiaries in a life insurance policy? A. Benefits are paid equally to each named beneficiary. B. Benefits are paid to the surviving members of a class of beneficiaries. C. Benefits are paid by right of representation to the deceased beneficiary's heirs. D. Benefits are paid to the trust established for the beneficiaries. Answer: A. Benefits are paid equally to each named beneficiary. When beneficiaries are designated per capita, the death benefit is distributed equally among the named living beneficiaries. If one of the named beneficiaries predeceases the insured, their share is forfeited and divided among the remaining living beneficiaries. For example, if a policy designates 3 children per capita and 1 child dies before the insured, the remaining 2 children would each receive 50% of the death benefit. This contrasts with per stirpes, where the deceased beneficiary's share would typically pass to their heirs. Question 25. An applicant for a health insurance policy intentionally fails to disclose a significant medical condition on their application. This is an example of A. Warranty. B. Misrepresentation. C. Waiver. D. Concealment. Answer: D. Concealment. Concealment occurs when an applicant intentionally withholds or fails to disclose material facts to the insurer that are crucial to the underwriting decision. This omission, if material, can lead to the insurer voiding the policy or denying a claim, as they were denied information that would have affected their risk assessment. For example, failing to mention a recent heart attack when applying for health insurance is a clear act of concealment. Always provide accurate and complete information on insurance applications to ensure your policy is valid and claims are paid.